Hi everyone. I'm Aditya. I'm currently pursuing masters in finance here at UB. So prior to this, I come from a engineering background. I am a mechanical engineer, and during that time, I had a chance to work with a handful of startups, and during which I was also a part of their fundraising process. So I have closed close to 1 million to 2 million range of deals. And apart from that, I had one of my own venture fund facilitation firm where I used to help startups raise funds from VCs and also other family offices. So let's just get started with the fundraising part. So, from anyone who is currently there, do you guys have any experience or any idea about raising funds, or you previously did reach out to any investors regarding talking about your company or just having a conversation with them? I'm just not sure how would they respond, but let's just continue. So here, the first thing that I want to mention is not every investor is right for you. So fundraising is not the only aspect, or it's not only about money. So here there are a lot of benefits that you can specifically get from raising funds, and specifically from the investors that you choose. So each and every founder should understand their purpose of raising funds. So first advantage, which is obvious, is capital injection. So whenever the investor puts money into your company, it will be a little bit easier for the founders to build their products and hire new team members. So it would be less in terms of a burden. And the second and the most important part is network and connections. Whenever you end up finding a right investor in your sector and your specific industry, you will get a lot of network and connections that the investors personally have, so that it will be helpful for you as a founder to build your company and get the same network that the investor has, so that it will be mutually beneficial for both the parties. And the third one is knowledge and mentorship. Naturally, an investor carries a lot of experience and they know about different kinds of markets apart from uh, the sector that your company currently falls in. So they will be the right people to help you navigate through whatever the hardships that you're facing while building your company or a product. So the fourth one is credibility and scaling. So let's just say if there is any investor from Shark Tank, any big investor who is investing into your company, it is automatically validated that you are building something good. So the credibility of the investor is very, very important factor here. And the fifth one is the strategic support, which simply means that they will act as a right board member, and also they will help you structure your organization and also help you hire the right people. So it is very important for the founders to understand what is their purpose for raising the funds. Is it only money, or is it any other benefits that you want from them? So that is the first thing that you would choose whenever you're choosing your investor. Coming to the next part, let's just understand who are different kinds of investors and where do you usually start from. So the first and initial step in the pyramid is friends and family investors and also incubators. So friends and family is pretty much the people who believe in your idea and who usually don't expect any kind of return. And incubators are places where incubators pretty much are just like CoLab, you can understand. So it's like they help you build your product, they help you ideate, they help you in each and every step of uh, building the company. So they usually invest from 1K to 150K. The amount range might be a little bit here and there, but this is what they usually do. And the next step comes the angel investors. This is usually where you find uh, people like who have much more experience than the friends and family and incubators in investing. So it can be a multimillionaire, or It can be a founder who has had previously a startup experience and he has had good exits from the investments. So they usually become angel investors. So they invest in between 10K to 100K. And then comes the angel networks and syndicates. So these are a little bit bigger. So angel networks or syndicates is something like a pool. Let's just assume I have a company and I wanted to raise 500K. And syndicate is nothing but a group of investors coming together and investing in one single company. So here it is something like there will be a concept of lead investor who invests more money than the others, which is like a one single investor investing 300K and the rest two, three investors investing the rest 200K. So that is angel networks and syndicates. The fourth one is venture capital firms. These are traditionally just for startup investments. They have various sector focuses and also they have different check sizes ranging from 500K to 10 million. There are venture capital firms who also there are venture capital firms who also invest in between 100 to 500K as well, which are micro VCs, who are usually called as micro VCs. Then we have corporate venture arms and family offices. Family offices are something like uh, uh, they were in the investments from a pretty long time, and venture corporate venture arms is like a already established company, let's say like PepsiCo or Coca-Cola or let's say Mercedes-Benz or McLaren. They end up having a separate venture arm. So I recently got a chance to work with American Express Ventures. So Amex is usually for credit cards, and also it is a banking firm, but they have a separate arm which is usually to invest in the companies, the early stage companies. So that is a corporate venture arm and family offices. They usually have higher check sizes ranging from 1 million to 50 million plus. Okay. So the next one is very important to understand what are the cycles in startups versus the funding rounds. So during the ideation and validation stage, so it is usually called as pre-seed. What does pre-seed mean? Is this is before your product is out in the market, you're raising funds to build it. So that is essentially called as pre-seed investments. And then comes the early traction, which is after your product is out, you are having some initial traction, which is gaining, and you're still making some pivots from your original product. And that is when you raise the seed investments. And then comes the scaling, which is actually when the startup is in a growth stage. You start the bigger investment round, which is Series A. So even to reach Series A, you will be having this sub series, which are like pre-series A round, so that it would help you to when you raise pre-series A rounds, it will ideally help you to gain more traction and build more audience and gain more revenue, so that you are eligible to raise Series A funding round. And then comes the maturity stage where your company is already validated and you would have the ideal validation in the investment market as well. So usually it is pretty tough to raise during the level of pre-seed and seed levels. But when it crosses Series A and Series B, your company is already validated in the investor market, and it will be a little bit of easier task to raise the next following rounds of funding. And the exit is when your company is at a late stage, and it is usually Series D plus, or you can consider it as a pre-IPO stage. So the next comes understanding the investor jargon. So here you have eight important things that you need to consider. One is pre-money valuation. The second one is post-money valuation. Third one is dilution. Fourth one is ESOPs, which is employee stock options. And fifth one is the term sheet. And the sixth one is safe and convertible notes. And seventh one is liquidation preference. And eighth one is pro rata share. So we'll talk about pre-money valuation and post-money valuation later. Let's just talk about what is safe and convertible notes. So a safe is considered as simple agreement for future equity, which simply means that the investor puts in money right now without expecting any ownership. so that they just believe that the company will be growing and they will be doing good. And once that is done, they will be able to get the shares when you raise the next round of funding. So let's just say there is an investor who put money in your pre-series or pre-seed round. That would usually be considered as a safe note. So once you raise the seed or series A round, that is when their shares get converted. So this is usually for their safety, and also the company should not feel more burdened. And this is just a contract. The safe is considered as a contract. The convertible note is a debt instrument. So it's nothing but the investor gives you the debt, and once everything goes well, that will be later converted into equity, or you need to pay them the debt back with interest. So that is what safe and convertible notes mean. The next comes liquidation preference. Liquidation preference is nothing but when something goes wrong in the company, who are the investors or who are the stakeholders who will be paid first. So that is what liquidation preference means. So ESOPs is nothing but employee stock options. So out of your whole cap table that you have, what is the specific percentage of shares which is being assigned to the people who are working in the company? So that is what ESOP means. Term sheet is nothing but an agreement where all of the deal terms will be measured between two, will be included between two parties. One is the investor and the other one is the company. So you will have all the deal terms in a term sheet. It includes all the pre-money valuation, post-money valuation, and whatever is mentioned here. So the next one is valuation. So let's just talk about pre-money valuation and post-money valuation and investment ownership in simple terms. What does pre-money valuation mean? It is straightforward that the value of your startup before the new investment comes in. So let's take an example. So investors, let's say investor values your company at $4 million pre-money. So before the investor injects money into your company, $4 million is the value of that company. What is post-money valuation? Post-money valuation is pre-money plus investment is the post-money valuation. So the investment amount is 1 million and the pre-money valuation is 4 million. So the total would become 5 million post-money. So that is your valuation. So how do you consider the investment ownership? The percentage of shares investor receives after capital infusion. So it's nothing but the investment amount that the investor has put, which is 1 million, divided by what is the post money valuation, which is 5 million, is equal to 20%. The investor receives 20% of your company by putting in $1 million of investment. So this is the difference between the three of them. Now let's come to the most important part, which is the cap table and dilution. So cap table is usually called capitalization table, and cap table is the short form. So it's nothing but a record that shows who owns what percentage of that what percentage of the specific company. So let's consider an example here. Initially, founders have 100% ownership of the company, and let's say they raise $1 million in seed round at a 4 million pre-money valuation. So $5 million is post money. So this is just the previous example that I gave you. So investor gets 20%. Now let's consider on a later stage they have raised 5 million in Series A at 15 million pre-money valuation. So the same method again, you have 20 million post money valuation. So the Series A investor gets 25%. This is how the chart looks. So first the investors have 100%. First the founders have 100% of the ownership, and then when the seed investment is done, seed investors have 20% and founders have 80%. And then when the new shares are issued, founders have 60%, seed investors have 15%, and Series A investors have 25%. So here the point is, whenever an investment is raised, new shares are issued to the investors. So the automatically the pie will be reduced, but the number of shares won't be reduced. So whenever the new shares are issued, the existing shareholders will get a less chunk of that specific pie. Okay. So there are certain methods that we can use when you're looking out for the right investors. So first comes the stage fit. So do they invest at your level? Yeah. So most of the times I see a lot of founders wasting a lot of time, uh, reaching out to people, reaching out to investors who specifically invest in Series C, Series D level or Series C level while they are in a pre-seed or Series A level. So that is when you usually lose a lot of time, or you usually lose a lot of interest towards the investors whom you are reaching out to. So the first stage to filter out the investors is to understand if they are investing in your stage. So find the investors who are in pre-seed. If your company is at a seed level, you can find the investors who are specifically investing at seed level. And the second part comes the sector fit. Are they active in your sector? Do they have this sector focus area? Every investment firm or in every VC firm has their own sectorial basis thesis that they write. So they would be interested in certain sectors to invest in. So these two are very important filtering parts. And the third filtering part would be geography fit, which is nothing but, are they active in your region? How many active investments do they have in your specific geography? And the fourth one is ticket size. The most important one above all of these is the check size. Do they match the amount you want to have, or are they looking at companies which are higher than your check size? Because let's just say you want $100,000, and you reach out to a company who match with the both stage fit, sector fit, and the geography fit, and they start their investments from $1 million. That is a waste of time, because they don't end up getting their check size down for you, because it's more riskier for them to come into that investment sector. And if, the next one is portfolio conflicts. Do they already back your competitors? So this is a little bit peculiar, because usually people, there are a couple of investment firms who are not that caring about competitors, but unless and until the companies are already big. At the early stages, they don't care that much about the competition. But you have to check whether your competitors are there in their existing portfolios or not, in different geographies as well. So the next one would be value add beyond capital. Just as I mentioned earlier, what are the other benefits that you want to have from them apart from all the financial benefits that you get? So the top mistakes to avoid during fundraising, which is pretty straightforward. One is raising too early. There is nothing wrong in being bootstrapped for a while, so that you know you will have, if you have already a lot of resources that doesn't require money, it's good to first be bootstrapped and then eventually start raising funds when it is actually required. So if you end up raising too early, it dilutes a lot of ownership that you have, but your traction wouldn't match to the kind of funds that you are raising. And the next part is over raising funds. So whenever you raise more amount of money, or so it's just straightforward in our life as well. Whenever we take a lot of money, we are answerable to them. So it puts unnecessary pressure on you to build your product and not liking it in the end. So messy cap table is nothing but, you're considering everyone who gives you money and pulling them as directors or board of directors or anything like that. So messy cap table is usually a very problematic situation when you're raising bigger rounds of funding. So they use the Series A or Series B or Series C funding rounds. The investors who invest in those rounds would not appreciate having so many people on your cap table. So next one would be ignoring terms. So whenever the term sheet is there, it is a serious document that goes on before injecting the money into a company. So if you ignore the terms and just raise the money for the sake of it, that will bring you a lot of problems in the future. And short-term thinking. So if you're only thinking to raise money for the survival mode rather than planning your next 1 or 2 rounds of funding, that would eventually make you bankrupt. So these are some major platforms where you can find investors. Uh, I pretty much used all of them except CB Insights, which is a new one. So Crunchbase, Traction, PitchBook, CB Insights, and AngelList. These are the platforms where you can find investors. And apart from this, I'm going to show you a couple of methods to also find them over LinkedIn and other platforms as well. So, key incubation and accelerator programs, this is specifically for the US. So, Y Combinator, Techstars, 500 Global, Plug and Play, and Alchemist Accelerator. These are like top incubators who usually have a specific timeline for their applications, and they help you build the product completely, help you gain the initial traction, and also in the end have a very big pitch day, so that on that day you will be able to pitch your progress with them, and they will end up giving you the initial amounts of funding that you require to build your product. And I would recommend starting off with Y Combinator because it has some great resources to find great resources to find or build your internal or alpha team. And it also has a specific program for founders, or a specific cohort, you can say, which actually teaches everything related to startups and how to build the company from ground up, and it assigns founders to their specific industry mentors. So that is one thing I would recommend to do. And after this, this is the most interesting part. So it's like these are the two main platforms which I've used to find the emails of the investors. One is hunter.io and the snowp.io. These two are the things. And apart from that, sometimes there are these platforms don't work. Most of the times they work, but if they don't, I usually use these kinds of email pattern. So this is a standard email pattern for any company or anyone. So it's first name and last name, or first initial plus last name, first name only. So this is a pattern that you can follow and have a trial and error method. Obviously, out of this, the email should go to them in any of it. So thank you so much. And I will show you a couple of techniques that I use personally to get the investor contacts. So one thing I would want to show you is, let's just say if I uh, go to any website. Mm. So whenever you get any investor website, this is a venture capital firm, I believe. So once you go on to the team page, you will automatically get all of the people, whoever are present in that team. Uh, is the website visible? Is it presenting? Okay.
It is.
Uh, So once you're on their team, usually you can talk to anyone. So specific, if you click on this guy here, so he's an investment analyst, but there is nothing given here. There is no description. Let me just check. So you can talk to investment analysts initially. So they can help you navigate through so it's just like a ladder whenever you talk to the investors, or whenever you want to get in touch with someone in the investment firm. You start with investment analyst, then you go towards associate, then you go to the specific industry director. So if they have so let's just check what are their portfolio, what sectors do they focus on. Okay, So these are the sectors that they focus on. So for each and every sector, there will be a specific manager or a sector manager who is there. So at a second or third level of pitching, you will be able to reach them. So it's better first you start a conversation with the investment analyst. So usually their emails are available here. And if they are not available, what you can simply do is sign up on hunter.io, go back here, just go to the finder, uh, just paste the company's name. You can get it here. Done. You have their email pattern. So it's first name in the initial and last name at insidepartners.com. So if you want to talk someone from the team, so it's Aaron Zanger. So it's A Zanger at insidepartners.com. That's how you can find the email. It's pretty easy. So sometimes if you don't have their emails on the website, this is one method that you can use. And apart from that, let me just show you. Okay, you will also have, so this is Sequoia Capital. This is one of the biggest investment firms. So this is how the differentiation is being made. So seed and early, these are the people whom you can connect with. And if your company is in a growth stage, these are the people whom you can connect with. The same way, this is a management thing. So if your company is in a seed and early stage, let's just consider him. So his email is already here. So you can also read all of this just to understand what are the companies that they have invested in. So these are specifically this guy's portfolio. So it will be different for everyone. So this is a second way of finding the emails of these people. And the next one is whenever you go onto the company's LinkedIn page, there will be, let me just try to give you an example. VC or investor. Okay. So sometimes when you want their emails quickly, you can have it right here as well. So it will be mentioned in their description, or it will be mentioned somewhere here. So in the contact information. So most of the times it is mentioned here in the experience section or in the description section that is here. Let me just show that to you. Yeah, in the about section. So usually it is mentioned in the about section or here. The best part here is some investors, most of them actually, they they mention what are the areas that they focus on, and they give they give their email for reaching out. So that is where you can take the emails from as well. So these three are the kinds of methods that I use. And this one, the hunter.io is something that I recommend every one of you to use if you want things quickly. So it's just you need to understand the email pattern of that specific domain. And once you understand that, the rest of the things depends upon you on how you email them. So that's it. These are the things that I wanted to mention. And apart from that, whenever you're reaching out to any specific investor, what I would say is that just focus on three things: why, how, and what. Write very crisp email, and also have a one pager of your company rather than sending them out your whole pitch deck. Just send them the highlights of your company. Once they are satisfied with it, they will reach out to you again, and then you can build up a conversation and send them your pitch deck. So ideally, if you ask me about the timelines of sending the emails, what worked out best for me is sending out the email on Tuesday at 11 a.m. So because on Monday they are usually busy, and each firm has their own specific days where they check the new pitch decks that come in. So it is usually Fridays or Tuesdays, end of the week or starting of the week. That's it. Thank you so much, guys.
Awesome, Aditya. Thank you so very much. Does anyone have any questions before we'll conclude today's first session? Give a moment to, I know there's a few people who might be in a chat. Feel free to drop it in the chat. Well, Aditya, thank you so much for your time today. Greatly appreciate it. If anyone does have any questions, feel free to email UB CoLab. We'll be happy to direct any questions forward on from there. And otherwise, thanks for joining us for the first masterclass for the semester. Next week, we have Julia Jornsey Silverberg joining us to talk about marketing and establishing yourself on social media, which is always a great thing both for personal and professional knowledge. So hope you join us again next week. Thanks for coming out.